Welcome to PhillipCapital's Market Watch. I'm Eric Lee, Sales Director from Phillip Nova. In my last Market Watch, I shared a twin engine strategy for investing in growth stocks that are trading at attractive valuations using Salesforce.com as an example. Do check out the link in the info box below if you are interested. In response to that video, I received some queries on how we can perform fundamental analysis on stock market indices like the S&P 500 and Nasdaq. Most futures traders rely on charts to analyze stock indices and perform technical analysis. Although it is a good tool, it only unveils a limited aspect of the factors that could influence the market. There are many other tools that we can rely on to give us a fuller picture on the underlying conditions that drive the market. Using a top-down approach, we start by analyzing the economy. Let's look at the monthly chart of S&P 500 together with the new single-family houses sold index that is reported by the United States Census Bureau every month. The sale of a new house occurs with the signing of a sales contract or the acceptance of a deposit. The house can be at any stage of construction, not yet started, under construction, or already completed. Though new home sales account for only 10% of the US housing market, we can see that it is a good leading indicator to the stock market. New single-family houses sold index typically peaks 1 to 2 years before the US stock market, as represented by the S&P 500 peaks. From the chart, we see this in the 2000 tech bubble crisis, 2008 great financial crisis. Most recently, this economy indicator peaked in August 2020, almost 1.5 years before the S&P 500 peaked in January 2022. Next, we can study the financial valuation by referring to the S&P 500 price-to-earnings ratio. The PE ratio is not only available to individual stocks, as what we have analyzed using the Salesforce.com example in our last video. There are data providers who have published this valuation metric on stock indices like the S&P 500 as well. The way we use it is similar to how we use it for individual stocks. Basically, it is more profitable to buy the index if it is trading at a lower valuation of its historical trend, as compared to it trading at a higher valuation. Over the past 30 years, we can see that the S&P 500 trades within the range of the 17 times to 25 times of its price-earnings ratio. There are periods which it traded much higher and lower than this range. Yet, mid to long-term traders should do well if they bought in when the index was trading at or lower than 17 times PE. So far, the analytics method covers are more beneficial to mid to long-term traders. Next, we can use the advanced decline line indicator to read the pulse of the market. ADL is a technical indicator that plots the difference between the number of advancing and declining stocks of all US stocks on a daily basis. The indicator is cumulative, with a positive number being added or negative numbers subtracted from the prior number. If we see S&P 500 making new high, but ADL failing to do the equivalent, this implies that the advance lack strength, and traders can look out for the index to weaken going forward. Conversely, if we see that the S&P 500 making new lows, but ADL failing to achieve the equivalent, this likely implies that the price drop lacks conviction, and traders should therefore look out for the index to strengthen next. Lastly, always remember this age-old advice: do not fight the Fed. Long-term investors can invest in stocks based on the fundamental strength of the companies alone. In fact, market gyrations caused by the Fed's policy may even offer opportunities to invest in a company at attractive valuations. Yet, for traders with a short-term outlook, it is more beneficial to pay attention to the economic policies and learn to fall into the rhythm of the ebb and flow of the stock market as a result of Fed's action. That's all for PhillipCapital's Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube.